question is what all these job cuts mean really for the financial industry, for banks, other financial institutions. Let's ask Zaheer Ebrahim. He's Executive Director at Kennedy Group, which specializes in recruitment within financial services. Thank you so much for coming in.
You're very welcome.
So at the beginning of the year, in the first 2 months, banks were increasing their headcount by 5% in anticipation of a strong trading year in investment banking. This didn't happen.
Well, I think what we're seeing at the moment is we definitely have a bull-sized workforce in a bear market economy. In the initial 2 months of the year, you're correct, headcount was up around 5% across the banks in anticipation of a strong trading financial year. But the reality of the matter is we are currently down in terms of trading revenues around 18 to 20% on last year. But I think more interestingly, if we look at first quarter earnings compared to second quarter earnings, where the banks announced anywhere between 30 to 35% reduction in P&L.
Which explains the job cuts.
Right.
Yeah, and
right.
I mean, we're just hearing from Elliot there that RBS, following in the footsteps of other banks in slashing jobs, and with all the cuts, what, we're down 10 to 13% already this year, but it's actually about to get much worse, isn't it, with more redundancies to come? How much worse is it going to get?
Well, I think at the current levels, in terms of the announcements that have been made on the job cuts, we're in the midst of this recruitment downsize. I think at the levels we are at the moment is 10 to 13%, but I think the right market value is a minimum of 25%.
A minimum?
Yes,
So
correct.
actually we could get even more cuts.
Absolutely.
We could be even higher than that by the end of what's the worst case scenario by the end of this year for the financial
I would say anywhere
industry?
30%, anything above 30% would be a worst case scenario, but I think the right level is 25%. I think also what is going to happen towards the end of the year is banks are going to try to protect their bonus pool. It's very similar to the recruitment business. 20% of all bankers produce 80% of revenues. In order to compensate those bankers, you need to protect the bonus pool. So
Cutting jobs is an easy way of doing it.
Absolutely.
They could just pay their staff less.
Absolutely,
Keep
but
those jobs.
the banks continue to have that reputation of being the worst managed and run businesses out there in terms of their short term.
I mean, the idea is that they're doing it to protect their talent and to make sure that they retain, the people that they deem to be the most valuable, and so we'll boost the bank's financial position. And the losses seem to be concentrated in FX, commodities, and fixed income, right? Why is that?
Well, I think if you look at the second quarter earnings that the banks announced, those areas were seen a big decrease in trading volumes and revenue. And because these areas were highly stocked over the last 18 months in terms of headcount, it's only a natural progression to downsize some of those staff.
And the interesting thing about banks like Standard Chartered, HSBC, for example, which announced 30,000 job cuts, well, they're actually adding jobs in emerging markets. So is that a trend that we can expect to continue, slashing jobs in low-growth developed economies, but actually adding staff elsewhere in the world? Yeah,
I think it was interesting because the announcement from HSBC in terms of the 30,000 job cuts pretty much caught all the headlines. But I think it was 2 days later, HSBC came out and said they're also hiring 15,000 people in emerging markets. That is where the growth is at the moment. Emerging markets, Asia, Latin America, across investment banking and retail banking.
And that's where the dynamic is going with jobs as well.
Absolutely.
Okay, great to talk to you, Zaheer Ebrahim of Kennedy Group. Thanks very much for coming in.
Problem.